David Shapiro here with the Shapiro Group, my colleague Lee Abraham, and we're excited to talk with you today about some Austin commercial and what's going on in the market there. So we're going to break down some of the different sectors, and let's go ahead and dive right in.
So David, as we begin this conversation, we're going to take a look at what's happening nationally, as well as forecasting some national trends and then dialing it down specifically to the Austin market. This is some information that we got from NAR, which is basically setting the expectation that the federal funds rate will continue to go up and probably reach 5%, according to NAR, but then likely a pullback on the rates at the end of the year. Creates a very interesting dynamic in terms of market expectations. It's not a guarantee that it's going to happen, but this is the forecast that we're using as we take a look at what might happen in 2023.
So the different types of real estate we're going to talk about: multifamily, office, industrial, and retail.
Yeah, we're going to break it down by sector, and let's get into the details.
So here it shows, you can see each of the different sectors labeled, and this is showing the price index, so how these different sectors have appreciated over the last 18 years, because it goes back to 2005.
Yeah, right.
And starting them all from roughly the same point. And you can see apartment has outpaced the others because we know what kind of headwinds some of the other types of commercial have faced, like office, of course, with the pandemic. Retail affected there as well, but not only the pandemic, but other trends that were prior to that, online shopping, etc.
Right.
But residential still holding strong, apartments.
Well, yeah, and one of the keys is the affordability or lack thereof in certain locations, multifamily being a viable solution for folks. And we're going to break it down, but I thought this was particularly interesting when we look at the trajectory of these different sectors and what does it mean as an investor, where are the opportunities.
Also interesting is how you can see office actually from 2019 to 2022 is almost flat. It's actually up a little bit. Industrial just taken off in 2021.
And that's a function of a lot of macros and kind of getting back to the basics in manufacturing here in the USA, which is good news for the long term. So when I see this, I think about DNA. I don't know why. It looks like a DNA diagram.
I see that, for sure.
And basically the concept here is that we've got investment prospects in the left column, development prospects, which is near and dear to your heart, is bringing real estate to the market. And the way that it's set up is you've got your various sectors on the line items at the top. On the investment prospects is moderate to a moderate income apartment, workplace apartments at the top. The idea being that the dots going from top to bottom, the further to the right, the stronger the forecast of the viability of that sector. So as we look at this, the investment prospects that are at the top, moderate income workplace apartments, data centers, fulfillment, life science facilities, medical offices. Those are the top 5, David, and this is national. When we take a look at the development prospects, again, data centers, fulfillment, the moderate income apartments, life science facilities are the top 4, and 3 of those are essentially industrial uses for the most part. The 5th development opportunity that's listed in terms of their viability is single family rental housing, David.
There's now some companies that have stepped into that space, Invitation Homes, some private equity funds that are buying thousands of homes. They got a bad rap in 2021 because people were saying, well, prices are going crazy because these companies are just buying all those single family homes, which I think there was some truth to that. They were buying a lot of homes, but I mean, the demand was there for the rental side too. So
it's just a kind of a newer twist on an old theme. Typically, single family homes are built to be sold and apartments are built to be rented. These are homes being built to be rented, which is interesting and creates opportunity for astute investors.
So there's 37 million residents in structures or 5 or more household units. So 1 to 4 family is considered residential and 5 or more is considered commercial. So that's why this is differentiated this way. So 37 million residents. Point here we're trying to make is there's a lot of opportunity in this space.
Absolutely. And when we take a look at the dollars on the next slide, this is a $3.4 trillion sector of the economy, absolutely huge and is growing rapidly. So what does that mean to the consumer first, which is that rents have been going up on average anywhere from 3 to 5%. Here we see a figure of 3.7. And then the real metric from the equity side, from the investment side, is the cap rate. So if you want to get more information on cap rates, we have a special video, kind of a short, succinct video on what is a cap rate, how do you calculate it. As we go through these different sectors today, we're going to look at each one's forecasted cap rate. This was 4.9 over the past 12 months. And we're going to see that that's a relatively low cap rate compared to the others, which means lower risk and potentially greater return on the back end based on appreciation.
Rent price growth won't likely hit the 2022 highs.
Right.
So not meaning rent prices, but just the growth rate.
And part of that is that the rapid acceleration of development in response to the demand is what we're starting to see come to the market, and it's impacting the supply demand from a consumer standpoint as well as from a developer standpoint.
And, again, this is USA, so this is not Austin specific, which is a different dynamic.
Right.
The forecast is that demand will remain strong, and buyers need to earn more than $100,000 to afford to buy the median priced home, yet only 15% of renters earn that much.
Yeah, and so here we get into the affordability dynamic, and you start taking a look at, from an Austin standpoint, the inbound migration of jobs, typically in the tech industry. What are the annual household earnings that are related to that? And so there's a disconnect between the sector of the population that needs housing and what they can afford, and then the American dream being that disconnect. So the idea here is that now is the time to buy if you are a first-time buyer, because those rents are just going to keep going up.
There's a lot of people that, they're going to have to keep renting.
Yeah. That's the ugly truth, and I think we wrote something about that a while ago.
We did.
Yeah.
We wrote a blog article. It's on our website, and you can read that blog post talking about the ugly truth of real estate, which is, it's unfortunate, but we're just saying it how it is.
So these are just some basic stats. Now we are talking about Austin, and depending on how you calculate the numbers, they'll vary a bit. But basically, everybody knows rents have been going up in Austin. The figures that we have here is about 13.5% annual increase for one bedrooms, two bedrooms right there at about 13%. And then when we start to compare our market to other markets around the country, clearly there's a premium in Austin. This is saying a 51% higher than the national average over the past 24 months, a 25% increase. Again, if you are in position to evaluate that buy versus rent decision, our guidance is the green light is lit because these numbers are going to continue on their trajectory.
So that would put the national average over 2 years was something like 17%.
Something like that.
And this was 50% higher.
Right.
So the 50% higher could be deceiving because it's going from 17 to 25%. The national at 17, Austin at 25.
That's why we use this bar chart, give you a little different data visualization. And here you can see some of the seasonality, but also underlying this is the supply-demand dynamic. More supply coming to the market. It's not fully being absorbed as soon as it hits the market, and that tends to soften the increases. And so
you can see the decreases in 2020, right? That's what you would expect. They didn't go down a ton, though, because leases are annual, so they're not, everybody's not all of a sudden in March of 2020 changing their lease and getting a lower rate.
Right.
And then as demand increased going into 2021, rents went up pretty significantly, peaked in the second quarter of 2022 of last year. I've come down a little bit since then.
Anecdotally, some of the first-time buyers that I've been talking to are motivated because of the increases in their lease renewal they're being faced with.
It's nearly 15,000 new housing units added in 2022 in Austin, which sounds like a lot. 7,700 of those were absorbed, meaning they got leased up, which I'm actually surprised that it's not 100%, but there must be a delay here between when units are completed and when they're actually able to be leased. And so I'm sure that's getting absorbed as we speak here in 2023. It still seems like rents are quite stable. It's not like we have an oversupply all of a sudden of housing inventory.
So as we dial this down to some of the things that we're working on, we have a 60-unit apartment building that's being developed that we have listed for sale. And when we're valuing that property, we're taking a look at the ramp-up time as a new construction building to reach a stabilized net operating income. And so that's what's happening here with these new units hitting the market. It takes a while for them to be fully occupied. Main thing is you've got over 50% absorption in the first year, and that's a good metric for the market as a whole.
There you can see the average annual deliveries of 13,000. So 15,000 last year, right around what the average has been for the last 3 years.
Yeah.
let's talk about office.
Okay.
We've got rent growth in Austin for office, which some people might be surprised. Austin is known to be the strongest office market in the country. So even though I've heard stories of, office space in New York and San Francisco just empty and it feels like a ghost town in some of those office dominated neighborhoods, that is not the case in our downtown where we have office, but we also have a lively scene still.
Right.
And most of that office is being occupied, even though you hear Meta is not going to take their lease, lease some massive amount of space in a new building. They're not going to take it. They're going to sublet it. But that space is still desired, and there's a good amount of demand here.
So as we're looking at the office sector, we're going to be comparing these cap rates. At 6.9, the office sector is valued as the riskiest investment class relative to these other commercial silos, if you will. And I think that speaks to what you were talking about around the country. Certainly here in Austin a little bit, but relatively speaking, the offices can be a risky proposal. We've noticed, David, with a lot of our clients that are successful business people, after they purchase their trophy home and maybe their recreational property, they start taking a look at, well, let me invest in real estate for my business, for my company. And we're working with owner-occupant office consumers as a great vehicle for creating wealth with real estate and putting the money back into your business. And we've got some interesting anecdotes and stories we can tell if anybody's thinking about moving your business into a property that you own. We'd love to chat with you about that. We've got some great success stories recently on helping our clients do that.
After 2 quarters of negative net absorption, meaning that there was actually more vacancies being added to the office inventory, in the fourth quarter of last year, net absorption turned positive again. So meaning that there's actually more office leased than new inventory.
Right.
So basically we're going in the right direction in terms of office rebounding.
Right. And one of the keys on that is, not all offices are created equal. And as we look at the next slide, this is your thesis. This is the David Shapiro theory of real estate, which is buy the best because it's always going to have the greatest demand.
Yeah, I mean, I said this in terms of location, right? Like if you can buy in the best neighborhoods in Austin, buy there because they're going to appreciate more. They're going to hold up better in downturns.
Right.
Actually, Zillow put out a book like 10 years ago. I read this book, and it was saying that property appreciation in nicer neighborhoods is higher, which you would make sense. Like if you have $1 million property and it appreciates at 5%, that's more than a $500,000 property appreciating at 5%.
Right.
But in addition to that, the rate of appreciation is actually higher in the nicer neighborhoods. So that $1 million home might appreciate at 7% versus the $500,000 home at $500,000 as like a simple example.
Mm-hmm.
So it's a compounding effect. And so that's what I've always said is like just buy, the best neighborhood you can, or the best, not necessarily property, but the best area. In this case, Class A office space. Office is quite a bit different than residential in this sense, but if you get a high quality asset that it's going to be in demand.
The main thing here is that from the investor standpoint, if you're choosing among various types of office space, everything else being equal, pay a little more, get a little more, and you're going to benefit in the long run, and that's our guidance there. Mm-hmm. David, one of the things that we deal with daily is recency bias, whether it be sellers who, their home didn't sell over the weekend, the first weekend it was on the market, and oh my gosh, what's happening? Buyers being shocked at a 6.5% mortgage. All of these things are a function of context, recency bias. They're just thinking about the current market that they're coming out of and comparing things. Here we can see that the 3 months ending in December of 2022 was nearly half the activity of a few years prior in 2019. And as a result, the vacancy rate is going to continue to be stronger than we would like and higher than the pre-pandemic levels, which was basically at about 12.5%. So commercial real estate office, if you're purchasing it for the revenue stream, a little bit riskier for sure. If you're an entrepreneur business person, to me it's a no-brainer if you're currently leasing your space to start looking at owning your building.
Mm-hmm. Here we are. We have the market beat, the office report for Q4 2022, the most recent one.
Right.
And Austin employment remains stable despite growing recession fears.
So we're talking fundamentals here. Austin, we believe, is the strongest local economy in the country, perhaps the world. And so as we're reading and hearing these doom and gloom headlines from the national media, trying to stay on point with the fundamentals, and employment here in Austin is stable. And then the next bullet you can see is vacancy rates are on the rise as sublease space increases. So you've got a two-tiered market there, subleasing of companies that are either relocating. We have a client that we were working with that has a medical triple net lease property, and the tenant chose to move out of that market, yet they are still paying their lease rent for the remainder of that term. That's why triple nets are a wonderful risk reduction strategy. But that gets into the sublease market. And there's more and more sublease properties coming up, and that's kind of what this is talking about. Creates opportunity for the user, for the occupant. Let's take a look at the next page on this, David, and just take a quick look at which locations are strongest for Austin. And part of that is vacancy rates. So you can see the highlighted column towards the middle of vacancy rates, with the lowest vacancy rate per sector basically being the central core, which again is to your thesis, and then the highest vacancy rate at 38, almost 39%, is the northeast sector of our market. So what does this mean? What it means is if you're investing in this sector, we're going to take a deep dive look into the specific location and the supply-demand dynamics. This is just giving us an overview of where our market sits in some of the various locations in Austin.
One very attractive way to play commercial real estate is what we call a covered land play. I've also heard it called land banking.
Okay.
And basically what we're trying to do is buy a piece of land that we really like and have some sort of an income stream on it. So that way that you're not just sitting on a piece of property losing money every year because you're paying property taxes on it. So what's something that can generate revenue? And in Austin, just to give you a sense, it's like, well, what, property taxes? Well, if it's $1 million property at 2.2% roughly is what taxes have been in the past, that's $22,000 a year. And I mean, you can just do the math, and that's if you own it cash, right? So your cost of capital is whatever the risk-free rate is. Let's call that 5% right now, plus 2.2%. So 7.2% is what the hurdle you need to exceed just in order to have this be a profitable deal. So if that's the case, one way we can reduce that is, well, hey, can we generate 4% or 5% and get that down to like a 2.2 and with appreciation and development play at the end, really make this thing a home run. Ideally, you'd have no cost throughout the duration, and we've done deals like that, but that's just not a very likely thing to find. So, assuming there's going to be some cost throughout the holding period, and then a nice development play at the end. And so generally we're trying to find stuff that you could develop today, and it's a profitable development play. So there's a couple, so we'll go over kind of the elements that we're looking for. So that's one. Two, there's some sort of an income stream. So an example would be, talk about the Rosewood story that we have labeled here, is our client, we found a property that had really great entitlements, meaning the amount that they could develop on it was really strong. They had an existing structure that needed minimal work, and this allowed our client to go in and occupy it as an office for his company, lease out some of the other space to some other businesses. And so now not only is he was paying however much in rent, so that's going towards a mortgage payment. He's got some rent coming in from some other office users, and he now can, at some point down the road, develop this and have it be a pretty profitable project. And it already was. Like, he could have developed this on day one and made some money from that. So now he's going to get to ride the appreciation wave in Austin, but with a much lower cost basis, lower risk. And at the end, he can develop it, or he has the option. Maybe he just tees it up and sells it to a different developer. Right. So it just depends on what's going on for that owner at that point in the future, their risk tolerance, the prices. There's a lot of variables in there. But I really like this because it gives somebody a lot of optionality. You can do this with something as simple as a single family home, which I bought one that you found for me in 2021, that they were selling this renovated home, but they were selling it at land value. So essentially for $800,000, I bought a piece of land that had a renovated move-in ready home. And so I put some tenants in there, and now the thing is break even for me. But I'm sitting on a piece of land that at some point down the road I can develop. And
Absolutely.
could build 2 houses on that, could build 1 large house.
Right.
And I just like that idea of being able to have the optionality.
Most folks are familiar with the single family home dynamic, and it is something that's easily understood. You can wrap your head around it. Sometimes this commercial stuff can seem abstract and a reach for folks that aren't familiar with these property types. So we can have a lot of fun helping people not only get a great deal, but actually begin a new real estate adventure as they get into some of these commercial properties. And that's why we felt it was important to do this video today. Last thing I'll mention before we move to the next sector is that for those of you that are risk averse and want to get into this sector, the medical office leasing can provide that hedge. Oftentimes they're on a triple net basis. They can be longer term leases, which mitigate your risk. And with everything going on in the world today, the medical industry is well established and will continue its hold on our attention and our economy.
Yeah, and so this is a much longer term, generally covered land play because you're getting a 10-year or 15-year lease.
Right.
And so really it's just like a bonus to these triple net leases. So we'd let, sometimes people come to us and they just want triple net. They're going to get some great cash flow. Of course, if we can find one that has, hey, look, we think this thing has some development potential down the road, the way that the path of development is headed, direction of that, where rent prices are going and sale prices. So I think that's just like a bonus. Like, hey, we think this is going to have some good development potential down the road. So this is a combination of a triple net where it's very safe, but also you have some potential upside.
Absolutely. And we're blessed in this market to have a periphery around that central core that's rapidly developing, and these covered land plays all day long are out there for a sophisticated buyer.
Yeah, and it's sometimes hard to see, but for those of us that have been here over a decade, and you think about the areas now that were like, man, I wouldn't even thought to buy something over here 10 years ago, and now this is like a booming area to say, okay, well, what's it going to look like in 10 years? And sometimes it's really hard for people to visualize that, but to know that the city is going to continue to change very fast, and that's going to continue to happen. And you made a comment about people that are risk averse. I think one thing with most of our clients, all of my deals personally, is I'm looking at them mostly from a risk basis and making a risk adjusted determination in my head on, okay, well, what are some of the factors in this that are going to make it risky? And do I feel comfortable with those, and trying to minimize that as much as possible? And I get pitched stuff all the time. And generally I've started realizing, like, what is it that about this investment that I don't feel comfortable putting money into doesn't have the risk profile that I'm looking for. And so I think working with people to understand what their risk profile is, and then helping them find something that meets that. And most of the real estate deals we're doing are not that risky in the big scheme of things, especially in a tech town like this where people are putting money in angel investments that 9 out of 10 times are going to go to zero. And meanwhile, we're putting money into investments that 9 out of 10 times are going to go up in value. It's a much different risk profile.
It's a matter of context. Great stuff. Let's keep rolling through our next sector. It brings us to industrial, David.
I would love to own some industrial. I will say that. So hot sector right now. You can see the rent growth in the last 12 months, 11.1%. Cap rate, 6.2. So showing that it's less risky than office. But still seems, say, more risky than residential, than multifamily.
And part of that is the dynamics of who the users are, who the occupants are. Again, in Austin, because of the periphery being rapidly developing, oftentimes industrial properties are at the perimeter, the fringes of development. There's a lot of reasons for that. Part of it is zoning, part of it is the economics, the cost of land being cheaper out in the boonies, if you will. But with Austin's path of development being very clearly defined along that I-35 corridor, we look at what's going on in Hutto and Taylor and some of the other towns, also down in Bastrop and Lockhart, some of those areas down south. Using the industrial as a covered land play is perhaps, to me, the savviest of all strategies, because there's a ton of demand right now for industrial space. We noted that at the very beginning with some of these other uses being rapidly developing. High demand for the current use, and then huge upside for redevelopment down the road. So love industrial, and actually it's just a great reaffirmation of what made this country great to begin with, which was, our manufacturing strength. And so that's coming back, and that's a good thing. 6.2% cap rate. These are benchmarks. Any particular property, there's going to be some variables in there that will impact the cap rate, but for comparing these sectors, I think it's useful that we are looking at these to get that relative comparison. One key point here, David, as we forecast is that unlike the office sector, which really got hammered with the pandemic, the industrial space benefited greatly. One simple way of thinking about that is more people ordering stuff from Amazon. That stuff needs to be delivered. There's a whole supply chain, warehousing, and all that kind of thing. So what the slide is basically telling us is compared to pre-pandemic levels, demand is strong as net absorption was above 400 million square feet in the last 12 months, ending the fourth quarter of 2022. So this is a trend that's moving in the right direction for our investors. So David, here we have the Austin breakdown for fourth quarter of 2022 industrial. But I think for our purposes today, as we're helping people identify the path of growth and development, we can look on the second page of this report and just quickly look at some of the specific locations around town, their vacancy rates and so forth. Take a look at Cedar Park, 0 vacancy. Wow. Take a look at the Central Corridor, damn near 0%. It's hard to find a double-digit vacancy other than Georgetown, and that's just over 10%, just over 11%. So these numbers are bearing out what we've been talking about based on that demand as it relates to low vacancy. Your business, if this is a viable opportunity, one of the things about industrial that's very attractive is that it's being used to office in a lot of cases. If the business is not dependent on car traffic and foot traffic, some of these near locations on the periphery make wonderful office space, and then there's a lot of other uses that the businesses can generate revenue from these industrial properties. And so that's what we're seeing here with some of these different sectors. Depending on where your business is at, we can help you identify the great location. If you're an investor looking to own these properties, generate the revenue, and then maybe redevelop them, there's a little bit more involved. This is not as well organized as some of the triple net properties that we typically work with. There's a lot more involved in vetting the right occupants and things like that.
So cap rate of 6.7%, pretty close to the office cap rate. Again, a representation of the risk factor here. And rent growth 4% in the last 12 months. Right. I mean, I'd be curious what the 12 months prior to that were, but the last 12 months was kind of like the re-emerging from the pandemic.
When we take a look at a 4% rent growth, that is not an insignificant number. It's statistically significant. It's showing the movement in the right direction if you're on the equity side. Mm-hmm. If you have retail space, what does it mean? It means that if you're renting it, your expenses are going to keep going up. There's a lot of good opportunities to acquire retail space, be that occupant. Just telling us what we already know, which is that the demand is basically picking up. And if we look at the next slide, it's interesting. It's saying that demand for retail space was stronger in 2022 than the previous year. Net absorption is positive for the 8th straight quarter, meaning that there's more demand than supply, and that's going to continue. We're looking at a 21 million square foot of office space in the fourth quarter of 2022, and that's a 52% increase from the third quarter. So a little bit of a red flag for any long-term development plan. The key is to buy now and get ahead of that curve rather than let it get ahead of you. So what you're basically looking at here is net absorption kind of going down in the first quarter of 2022, but then way up over the subsequent quarters. And in fact, 4 of the past 5 quarters, there's been stronger absorption as it relates to supply. That's a good thing for our investor clients. When you're looking at various markets, some of our clients are looking at investing not just in Austin, but around the country. And so this is helpful information on how we compare.
Vacancy rates down from 5.2 in 2021 to 4.2% Q4 of last year.
Show me the money, David. Show me the money.
There we go. We got some money now.
We got some money here. And you can see that generally speaking, the rent is going up. That's a good thing on the equity side. Again, if you're on the rental side, well, might be a red flag to start looking to acquire property so that rent's not going to go up on you. All you're going to do is pay down your mortgage. Lastly, David, as we wrap up, one of the questions that we asked, are always asked, is this a good time to buy? Is this a good time to invest? What's going to happen in Austin? So anybody who's watched our videos knows that we really believe in the fundamentals here. And then this particular report from the Urban Land Institute. Okay, so this is a very well-respected source of information. Local market perspective, investor demand. This is not in alphabetical order, unlike a prior slide that we looked at. This is based on performance. Austin is rated number one in the nation for local market perspective, investor demand. And then on the right, you can see from a developmental standpoint, Austin is rated 6th in the nation. So those are very strong forecasts from a very well-respected, it's not just us saying, hey, we believe Austin's great. This is some validated third-party information that saying what we've been saying, which is Austin's a fantastic place to invest. Similar sort of deal here, Austin ranks number 4 for overall real estate prospects as well as home building prospects. And then finally, local economy. Austin again rated number 1. And take a look at number 2, Dallas-Fort Worth. Well, guess what? That's the I-35 corridor we've been talking about. We know that 3 of the fastest growing metros in the United States are right along that corridor between Dallas and San Antonio, with Austin right in the middle. Ladies and gentlemen, I'm here to tell you this is the time, and Austin is the place. Whether it's residential or commercial, we believe strongly that the green light is lit. Talk to us about how we can help you be on the right side of these trends.
Thank you for joining us talking about commercial real estate. If you got a lot out of this video, please go ahead and like it so other people can find it. Leave us a comment, any questions you have or something you liked in the video, and we respond to most of those. If you're interested in talking to us about coming up with a strategy for your investment portfolio, go in the description below. You can book a call directly, shoot us an email or a text. Go find me on Instagram, David Shapiro ATX if you'd like, and message us, and we'll find a time to connect. So we look forward to talking to you soon, and we'll see you on the next video.